Hey YouTube, what's up? I hope you guys have been doing good. It's been a while, I know, but yeah, I've gotten like a bunch of requests just to find out if I will be doing any more YouTube videos. And yeah, here I am. I'm back. I hope you guys have been doing well and keeping well. Alright, so let's grow this channel. I do believe that it can be of help to some of you, alright, whether you experience or not. I believe that the content within this channel can be useful, alright, so be sure to share this video around, share the channel around, and yeah, I will be dropping more videos. Okay, so for this video we're just gonna dive into the ICT 2022 model, alright, and just look at how we could have capitalized on a trade using that model. Alright, so the screenshot what you're looking at is Nasdaq on the 4-hour time frame. So when you're looking at the chart, alright, where price is at the moment, okay, you have to ask yourself, where is price most likely to draw towards? Okay, so the reason why I marked out the draw on liquidity, as you can see, is because on the daily time frame we took out sell side liquidity, alright, and we traded into a fair value gap on the higher time frame. So that gave me a starting point to believe that we might be heading towards the upside. Alright, so we might be heading towards the draw, alright, or even further beyond that. At that point in time, I did not know if we would go through that or use the drawn liquidity as a resistance level. Right, I just kept in mind that I would like to see price heading towards that fair value gap as a drawn liquidity. Okay, because you identifying where price is most likely to go to draw towards can also help with your bias. Okay, but let's just head down to the daily time frame. Just go to the charts just to show you guys what I was talking about. Okay, so let's actually do it on the weekly time frame. Okay, so looking at it on the weekly time frame, we can see that price has traded into this fair value gap right here, and price has also respected the midpoint of that fair value gap. Okay, so if we can do that, we can see that price respected the 50% of that fair value gap. Alright, so once we traded into that, we can then scale down to our lower time frames and look for more evidence to support the bias in which we believe that price would be going higher towards this point right here. Okay, so just keep that in mind, that reference point. I will draw that again, but just keep in mind that the bias was towards the upside, okay, being this fair value gap, using that as a reference point. So if we go down to the daily time frame and just expand this real quick. Okay, so let me just remove this because we know that this was the weekly fair value gap and price hitting the midpoint of that. Okay, so if we can look to the left, we can see that we do have a couple of lows here which we can use as sell side liquidity. Okay, so your liquidity pools in this instance being old lows and old highs, which we will use. Alright, you can use those liquidity pools as exits or entries. Okay, let me just mark this out as your sell side liquidity. Okay, so let's head down to the 4-hour and let me just draw that point out again. All right, so we had this draw liquidity. Okay, so that was the draw on liquidity. Okay, so just to go back to the screenshot, right, it's that point right there. So now that we have our framework, right, so now we just need to wait for price to give us evidence that will show us why it wants to head towards the upside. Okay, so the major point being that we took out sell side liquidity on the daily time frame. So now after that happens, we just wait. All right, so let's head down to the 1 hour so that we can head down to the Monday trading. Okay, so Monday's trading would be right here. All right, so on Mondays I don't usually trade, okay, because Mondays are usually tricky and sometimes the market just needs to settle in. All right, so from Tuesday, that's when I start looking for trades. Okay, so looking at Monday's trading, all right, we can see that we do have a gap here. So at that point in time, we're not sure if price is going to fill in that gap or not. All right, so we can just wait for price to show us what it wants to do. All right, so let's just mark out that gap. Right there. Okay, so just because there's a gap in the market, that does not mean that price has to fill it. All right, so just keep that in mind. As you can see on Monday, all right, we traded and we consolidated a bit. All right, price traded higher, took out the buy side liquidity. So once price dropped, we were obviously expecting price to close in that gap and maybe trade higher, but like I said, price does not always have to do what you want it to do. Okay, it's going to do what it wants to do. We just have to react on it, right? So after that, you can see we had a sloppy Monday, right? Nothing fun about that. So now moving on to Tuesday, okay, you can see we opened up, made a low in London, and then we traded higher. Okay, now let's just head down to the 15-minute. So on the 15-minute, what reference point can we use for liquidity pools? Okay, let's just mark Monday's high out. Let's just move this to the side. So we have got Monday's high, okay, which we can use as a liquidity pool, and Monday's low, okay, which we can also use as liquidity pool. Like I said, the trades will form by your previous day's high and lows sessions or your weekly highs and lows. All right, that's when you can look for your entries or your exits. Okay, so in this instance, like I said, we opened up, traded lower, created a low in London, traded higher, and then we traded lower again. Okay, so looking at this instance right here, let me just head down to the 5-minute just to explain to you guys why I wouldn't take this trade right here. Right, so based on the 2022 YouTube model, okay, what you want to do once you have your framework, you want to mark out 8:30. All right, so your liquidity pools before 8:30, that's when you want to start looking for trades. All right, so once 8:30 hits, all right, some people may look at this as a high being taken out, okay, right there, and then price trading lower, right, taking out a low, being a shift, and then wait for price to fall in that fair value gap and trade lower, right? You can do that, but just keep in mind that it will be short-lived, okay? Because like ICT says, your liquidity pools should be above your previous day's highs or lows. That's when you'll most likely get your high probability trades, all right? So the fact that we didn't take out the previous day's high said to me that I shouldn't take that trade, okay? But now once we traded lower, okay, we took out this low here, okay? So why am I referencing this low and not this low or the previous day's low? Okay, because this model is based on intraday and it's a scalping model, all right? So the fact that we took out a London low, okay, that can give us a clue to take long trades, okay? So let me just mark this out. So we do have our sell side liquidity came London, right, so that was a low that formed in London and we took that out, okay? So the fact that it matches with the rules, it happened prior 8:30 and it's a low in London, all right? Although we do have the previous day's low and the gap underneath that, okay, right there, it is possible for price to trade lower even after hitting this. However, looking closer at price, okay, we can see that we took out a low and we traded higher. So within this expansion move, we also took out a high right here, okay? So that also gives us another hint that shows us price has now a higher probability to trade higher. Let me just mark this out, right? We do have a market shift, okay? And once that happens, you want to go and reference what happened before price broke the high, before we had that market shift. You want to look at that area right there, okay, from the low to that high, okay? So once price retraces, you want to go to that reference point in which the market took out the sell side liquidity before 8:30, right? So once price trades to that low, you want to start stalking price on either your 5-minute, 4, 3, 2, or 1, right? We can also go to the 1 minute and see if we do have a clearer image of what we are actually looking for. Let's just find this point right here. Okay, right there. Yeah. Yeah, so there we go. So once we trade within that sell side liquidity, okay, right there, you want to wait for price to break a high, All right, so the break towards the upside has to be obvious. Okay, like this move was an obvious move. Okay, so why am I using this high and not that high? All right, because this high trades lower into that sell side liquidity. Okay, so that's why I'm using this high right here. Okay, and not the high after that, meaning this one right here. Okay, so once we have that expansion move higher, you wanna mark out your fair value gap. Okay, so we can see that we do have a fair value gap right here. Wait, let me use another color. Okay, right there, and right there. Okay, so let me just mark this out, fair value gap. Alright, so we can see once we trade to that, right, price respected that fair value gap and traded higher. Okay, so what you can use for targets is your buy side liquidity, either being the draw in which we had, alright, on the 4-hour. If that is too much for you in terms of holding, alright, you can use your intraday highs, alright, as your targets. Alright, so meaning that you can use a London high, alright, or you can use the previous day's high. Okay, so in this instance, we're just gonna use the high that happened in New York. Alright, so this is the AM session high in which we had. Alright, so we can use that high, right, as your target. Okay, or if you don't have trust issues in terms of holding your trades, alright, you can use the previous day's high. Okay, but keep in mind that it is a time-based high, so price might reverse there, so it's always good to take your profits. Okay, so if you trading price on the 5-minute and not the 1-minute, all right, like I said, we do have a high here which got violated. All right, so yes, we do have a fair value gap, but we do also have a order block right here. Okay, so you can also use that as your entry point. Right, so it's completely up to you, whichever time frame you feel comfortable. The main point is that you must have a liquidity run, right, and you must have a market shift, whether it's on the 5, 4, 3, 2, or 1-minute, and then look for your fair value gap, okay, as your entry point. Or if you good with identifying order blocks, you can use that. Okay, so if you were to use the 5-minute, all right, and not the 1-minute, you can put your stop loss underneath the low, all right, not the previous low, the low which got violated before 8:30. Right, so you don't want to use the low which took out liquidity. Okay, so meaning you don't want to use this low right here. Okay, because obviously your risk management, and you have to be okay with the risk that you put up. So I always like to use the low which got ran out before 8:30. So that would be cool for me. And like I said, you can identify your targets being the highs, all right, which formed right before that, or you can use session highs, or you can use your previous daily highs as your target. Okay, but if we do believe that price, as we've seen, trades from a weekly a PD array, and we believe that the draw on price is that fair value gap, okay, you can then just simply manage your trade, all right, in terms of managing your stop loss, right, and not collapsing the entire trade. Okay, so once price takes out, once price trades higher and through your previous day's high, and you can see, okay, there's no way that price is going to reverse, you can just manage your trade and then hold for the draw which we originally saw on the higher time frame, okay, which would be this point right here. So once price trades to that, you can then close your trade, because on that point we don't know if price is probably going to reverse at this level here, okay, we don't know that, or if price is going to trade higher through that and then reverse. Obviously we do have the benefit of hindsight because it already happened, but like I said, once this was your drawn liquidity on the higher time frame, you stick to that, and then once price trades to that, you can then collapse your trade, because anything can happen, right? So it's either you close your trade entirely, or you take your partials and you just manage your stop loss, okay, and then just wait for price to do its thing. So I hope this helps you guys understand the model a little bit more, okay. So when I do see these types of trades, I will make a video on that, but if I do manage to catch the trade, okay, I will show you guys the befores and afters, and obviously the executions, okay. So there will be a few hindsight examples and a few trade examples. So yeah guys, like I said in the beginning, let's grow this channel, let's share the videos, all right. I do believe it will be useful for you guys, but yeah, it's getting quite late for me. It's time for me to get some rest. I hope this video has been insightful to you guys, okay. Have a good night's rest, have a great day, a great trading week, and I'll talk to you guys, Lord willing. Be safe and cheers.